Hey everyone, welcome back to another episode of AWM Insights. It's Justin Dyer, CIO of AWM Capital, joined as always by Mena, Hanna, our portfolio manager. And we're going to jump into today, moving on from the series, although the series I would have to say is that series we just wrapped up over the past few episodes was perfectly timed because we're gonna talk about the current market and thinking through making good decisions. And proper portfolio construction is definitely going to apply to this current conversation. So unless you have your head in the sand, you're probably seeing a little bit of red when it comes to global markets around the world. And just kind of doing a quick flyover here, it's certainly been a rough week as of this recording. The year overall is very strong, I would say. There's statistics, let's say, back that up, right? We're still at double-digit returns, but there's been a lot of volatility. Doing a quick summary here, S&P 500 as of this recording is down 5.5% since its all-time high. It is down for the week at that as well. And technology stocks, the NASDAQ specifically is down 9%. Bitcoin down drastically, 30% off its all-time highs, and below, what some people believe to be an important threshold of 90,000. Again, as of this recording, it's in the high 80,000 per Bitcoin. And then ways in which we measure volatility, those things are going through the roof. So we're going to talk a little bit about why this is happening, at least insofar as we have a crystal ball and can figure it out. I will say, I'm kind of leading the witness there that markets are exceptionally complicated. There's a million variables, and there's going to be a narrative that you read. We're going to talk about. We could be right. We could be wrong. I think that's part of kind of what the answer to so much of this conversation is going to be. But inflation's part of that. Central bank policy is interest rates is really central bank policy. Another part, the geopolitical environment is also right there, right? There's a lot of uncertainty, continued uncertainty there. And really, I mean, it's a continuation of, I would say, what have been more dominant themes in 2025. It's easy to forget, over the summer months or kind of since April, really, it has been a nice market to be involved with. And like I said, the overall numbers for the year are pretty solid, up double digits in most marketplaces. But where we are right now is kind of similar to where we are to start the year. Optimism has faded. Inflation is potentially a little bit stickier than we would like, certainly than what the president would like. Central banks maybe keeping interest rates higher for longer, which is generally thought to be negative for markets and investment. The narrative around technology companies, mega cap, these large companies, a lot of them have exposure to AI. Maybe they're overvalued, and people are questioning anew what's going on. Hey, is this momentum going to continue? And at least so far, it's looking like we're at least taking a pause for the time being. So that's setting the stage. Mena, let me turn it over to you because I've talked far too much so far in this episode. But let's unpack it. What do when we're talking about this offline, what do we think's driving the market right now?
Yeah, driving the market is probably a more reasonable consideration of all of the factors that the markets have taken, call it a positive and optimistic stance on. We started the year with a lot of general optimism, new administration, inflation was coming down. We thought that the Federal Reserve would be pretty active in terms of interest rate cuts. And those two latter points have just been maybe have not matched investor sentiment and some of the predictions that we thought would happen, the markets thought would happen in early 2025. So inflation's remained a little bit sticky. The Federal Reserve has been cautious with cutting interest rates. It's happened a few times this year, but The market's projected far more interest rate cuts, and it's actually also looking like December is going to be a hold and it's not going to be a cut, which is an ongoing theme. So just as we find out more and see more, that optimism is shifting to realism and it is affecting market pricing as it should. I think this is exactly how it should play out. And this is what markets need. Markets need periods where they fall, and they also need periods where they could potentially over deliver and rally above our expectations. So these are constant forces, pulling and pushing forces, and we're seeing kind of the pullback dynamic right now.
Totally. I'm really glad you said that. I mean, that, if you don't listen to anything else in this brief conversation that we're having, that's the takeaway. In order for all of us to expect higher returns, to expect a return over and above what you can get in cash, essentially, or short-term government bonds, the markets have to do this, right? This is a manifestation or example of risk, right? You don't get returns without taking risk. It sucks. It really does, right? It's no fun to open up, log into your portfolio, look at it and see negative numbers. Now, albeit you shouldn't be doing that all the time, and don't pay attention to relatively short periods of time because, again, it's been a strong year. But the punchline here is that volatility, it is risk, and risk is required in order to have a higher expected return. Over long periods of time, that risk and diversification starts to really make it seem like risk isn't there. And then, you get these periods of time in the market where it just kind of goes up and to the right, and it seems like, oh, this is easy. Just, buy and hold to the moon, all that good stuff. But we know from the academic literature, from own personal experience, that this is what is required to get to this these outcomes that we are banking on to meet your priorities, right? We are structuring portfolios to capture this risk and be compensated for it is the great way to think about it.
Yeah, and to shamelessly plug 2 episodes ago when we were talking about swinging for the fences and how to actually play public markets, and the fact that you shouldn't swing for the fences, you should go for singles and doubles. Want to go back to something you said earlier in the conversation. The S&P is down 5.5%. It's still up around 13% on the year. So we went from an extraordinary good year, maybe a triple, call it, in the public markets, to now a double, something in between a single and a double, 13%. We like to think that markets will average roughly 10% a year in the public equity market side. So it's still an above average year. Is it a knockout year like it was kind of a month or 6 weeks ago? It absolutely isn't, but it is exactly like if you actually look at the year and forget that massive spike up in prices, which I would say was probably due to excess optimism, markets are behaving exactly as they should. And this is really the outcome that we want. Now, if you got ahead of yourself and bought Bitcoin at $126,000, and yeah, that hurts, but that is how you shouldn't play some of these markets. If you bought tech stocks, Palantir, you were up sometimes some months like 15 to 20%. Well, you could be down 30% this month. So it's all about playing the game in the correct way and making sure that you're setting yourself up to succeed. A single is still success. A triple is obviously better, but usually what we see is people that run that strategy to hit triples or home runs in the public markets end up striking out.
Right. Yeah. Great points. And it does really tie into this idea of making good decisions, applying the academic framework of making good decisions in the face of uncertainty, right? We need to have a plan going in. We know markets are going to have periods like this, and we're prepared to deal with them. That is why you don't try to swing for the fences every single time. You should do that, but do that in a real thoughtful way, and use proper decision-making techniques to allocate to private markets, or put money in places that are designed to have higher expected returns, but you have to do that in a thoughtful way. You can't just chase fads, chase gold because it's everywhere in the headlines, chase Bitcoin, et cetera, right? It's just kind of an unprofessional, unstructured way of building a portfolio and managing money. And again, the whole series we just did is really hopefully a great underpinning of this short concept I'm talking about here. One thing I definitely want to hit on kind of as we wrap too is, what to do from here, right? How to think about it. And I would say, again, tie it back to making good decisions. So we are faced with uncertainty. We're faced with uncertainty every single day. That feeling is more visceral when markets are negative, but you really can't let it change your playbook, right? You come in with a well-diversified lineup with different hitters, different defensive strengths, et cetera, using baseball as an analogy, and nothing has really changed, right? This period of time, if you have the right lineup and playbook going in, which you do if you're a client of ours, this is part of the game that we expect. And there are ways in which we can take advantage if things get worse, but we don't know. We don't have that crystal ball, but we know that the lineup and playbook that we have in place is the right playbook for the game right now. So take that. Definitely listen to the last couple episodes because I think you can apply a lot of that to this period of time. And hopefully this conversation was super helpful. If you want us to dig more into what's going on in the markets, we're happy to. It's something we pay attention to quite a bit. But just know, right, hitting singles, hitting doubles consistently, kind of that idea of playing small ball with the occasional well-timed and right-size home run when it makes sense for you and your priorities and your goals, right? Everything is unique to you. And what you're trying to accomplish, like that is the simple nutshell here. So we'll wrap there. Send us a text if you want us to talk about a specific topic or question you might have. 626-862-0355 is how you can get a hold of us. And until then, own your wealth, make an impact, and always be a pro.